Welcome to our next section. I've prepared for you a short business case. I'm going to walk you through some of the typical transactions that we could find in a particular business and then tie it back to the bookkeeping process. Here we go. We have two new owners of a startup. This is a partnership. We have Jasmine and we have Elijah. The restaurant is called Indulgence Restaurant. To open the restaurant, Jasmine and Elijah must gather and acquire essential assets. So I'm walking through this business case to make it real for everyone. Everyone who is involved in a startup literally has to buy things. You may not think about your buying assets, but you know you need to buy some fundamental items to help get the business off the ground. So when we look at the restaurant, we have to buy restaurant furniture. We're going to have to buy some food ingredients in order to be able to prepare the meals. We're going to have to purchase kitchen equipment. We're going to have to essentially buy what we call restaurant equipment, such as the cash registers that are going to be seated within the restaurant. And there's going to be other items that we buy. This is not an exhaustive list, but it just helps you think about it. Each one of these items that we've listed here would be classified as assets. The restaurant, furniture, asset. The purchase kitchen equipment. Again, equipment in this case would be an asset. The restaurant equipment, the cash register, equipment. The food ingredients, of course, inventory. We can't forget about the startup cash, right? So we're also going to have some startup cash. Maybe that's coming from Jasmine and Elijah solely, or maybe they have monies coming in from an investor. So we have to capture that somewhere. So an accountant or bookkeeper will show that as either monies from the investor or monies from the owner. And then we'll also show the money was put into the cash account. Other words, it went to the bank. In addition, the team will have several expenses that they will reoccur each month. And those will be such as the food ingredients used. So we bought the inventory, bought the food ingredients at the beginning, but now during the month we're going to use some. May not use all of them, but we'll use a portion of them. So we have to estimate the cost of that. We're going to have utility expenses to pay. In this case, of course, heating costs, electrical costs. We're going to have payroll because we got staff. We're going to have probably insurance to pay, in this case for the space, or insurance to protect our equipment from fire or flood or water damage. We're going to have to pay income tax as well. That's going to be an expense category. So all of these items are going to be considered expenses because they have to be paid each and every month. So we have our assets, those assets that we'll be using in the restaurant for a long period of time. And then we have these expenses that we will incur each and every month as we run the business. So let's think about how the bookkeeper will record some of this. This is what you're looking at right now would just be a sample income statement template. At the top would be revenues. You always, always, always show your revenues at the top. You also want to indicate what year they represent. And depending on the business, you'll have different revenue categories. So this restaurant could just have in-service, it could just be an in-service restaurant where people come in, they are served, they pay for their meal and they leave. They could also be an in-service restaurant and a catering restaurant at the same time. In that particular case, I'll have a line item for the in-service restaurant, and I could have a line item for catering services in the revenue category. At the end of the year, I would sum up both of those businesses or revenues from both of those businesses to come up with a total revenue count. As you see the expenses there, most templates will give you a full list of expenses. It doesn't mean that all of those expenses would apply to your restaurant. However, to keep it simple, they show you all the possible expenses. What you need to know as a business owner is which expenses are typical for your business. And that's when we get into understanding my business type. Services will have a certain set of expenses. A retailer will have a certain set of expenses. A restaurant will have a certain set of expenses. A manufacturer will have a certain set of expenses. In fact, the manufacturer will probably have the largest number of items being covered by that list that you see. But again, as a business owner, you have to determine and understand which expenses are most appropriate for your business. We put in those expense items, we total them up, and we're going to end up with a total expense number. The next thing we do is we estimate what our taxes will be for the year, and each locale will have different tax calculations. So that'll be up to you as a business owner to find those out. You could have a municipal tax you have to be concerned with, real estate tax, city tax, real estate tax, federal tax, many different taxes out there. So you want sales tax. So you want to make sure you account for the appropriate taxes and capture them in your tax line. So we have the revenues. We have the total expenses. We now have the tax estimate. So we go ahead and we now do the math. In this case, there's going to be some addition, some subtraction. So we take the revenues, we subtract away total expenses from total revenue. That's going to leave us what we call net revenue. We then subtract away the tax estimate that we've come up with. That takes away the taxes. Now we're left with what they call income from continuing operations. After that, if there's any other outside expenses that are not related to the business, but we're allowed to take away from the revenues, we'll do that. If there's nothing like that, then what will happen is that we'll end up with net income at the bottom line. So it'll be total revenues minus total expenses minus the taxes will leave us either a profit or a loss. So this is a typical template used for just capturing income, and we call it the income statement. Also, Jasmine and Joshua, in starting a business, may have liabilities that they've incurred. They went to the bank, they were able to secure a loan to help buy some of the assets that they have, buy the kitchen equipment. Maybe if they do have a catering business as well, they had to purchase a vehicle, and they decided to use a loan to do that. So we have another report, another document. It's called the balance sheet. The balance sheet shows the assets that you have, shows the liabilities that you incurred, and also your contribution, as we stated earlier, that we know is equity. The balance sheet can be reduced to a simple equation, and that's what you have in front of you. It's called the accounting equation. On the left-hand side, it says total assets. So for this business case, it'll be the assets for the restaurant. And what we're stating here is that the assets for the restaurant were acquired using monies. The question we need to ask ourselves is, where did the monies come from? And the balance sheet helps us to understand that. So if the money came from the owners only, in this case from the partners, Jasmine and Elijah, then total assets would equal to equity. The partners brought in $100. They have $100 in assets. 100 is equal to 100. But let's say some of the assets were purchased with debt, with loans from a bank. Well, in that case, let's say the bank contributed $75 of the $100. Now the accounting equation changes. We would still have $100 in assets, but now there'll be $75 of liabilities and $25 of equity. What does that mean in practice? It means that 75% of the assets that the business is currently using is owned by the bank. Over time, you're hoping that Jasmine and Elijah will pay that down. They will reduce it from 75%, maybe to 60, maybe to 50, maybe to 20, maybe to 30, maybe to 0. If they drop it down to 0, then they own 100% of their assets. So the accounting equation is a way of looking at how businesses were funded, and bankers pay particular attention to this because they want to see how much you have in liabilities. and how big that portion is relevant to how much you put in terms of equity. So the accounting equation. And again, that shows up on your balance sheet. So we're going to conclude this discussion around this case with this statement. We showed you the income statement and we showed you the balance sheet. Those are two of the principal reports that you'll end up using as a business leader. As a result, you need your bookkeeper to prepare those documents for you. They can use that income statement template as I showed you, and they can also use the balance sheet as a way of capturing that information for you and giving it to you as a formal record to help you make decisions in the future. So we concluded the business case. Overall, I just want to summarize for you what the bookkeeping responsibilities are. 1, documenting financial transaction details and monitoring the transactions. So documenting the financial transaction details and monitoring the transactions for you. Their job is to prepare the financial documents. We just described what those are. Processing accounts payable and accounts receivable information for you. So if you were a retailer, you may have accounts receivable transactions that need to be captured and recorded. They need to fact check all of your records, making sure that you're being charged appropriately, make sure you're not being overcharged by your suppliers. You want to reconcile your company's accounts. So looking at your bank statement, making sure there's no excess fees in there or unknown fees in there, or maybe they missed a deposit. Payroll processing for you, and also tracking your payroll data. Assisting with tax payments, and also assisting with returns. And last, working with other accountants as needed to resolve issues or conflicts. So let's say you do have a conflict with one of your suppliers, they sent you an invoice, there seems to be a discrepancy, they may have to work with their accountant to close out that discrepancy, to figure out where the source of the problem is coming from. So those are the responsibilities of the bookkeeper. And I hope that this business case that I walked through helped you to just think through and process that when you think about bookkeeping, yes, it does involve accounting. But accounting in this case is just recording your actions. So I hope you had a chance to see how your actions relate to accounting transactions.